Hello and welcome to a brand new show of Market Makers. Yes, we were away, but we are back. More importantly, we are back when it matters the most. It matters the most right now because macros are bad, but micros are getting better. It matters right now because if you're a long-term investor, if you buy into this fall, you will be remembered for certain periods of, you will remember your portfolio for a bout of volatility, but eventually this is going to be one of those periods where you want to be a buyer than a seller. The excesses in the market are getting flushed out, but volatility is here. So let's try and crystallize all that and much more with Sandeep Tandon of Quant Mutual Fund. Fantastic to have you back. Thank you for joining us. We're starting this series after a gap. So glad we're starting it with you. Summer of 2022. It reminds me of my college day bands when we talked about I know what you did this summer. Summer of 2022, when we look back a year from now, will it be the best buying opportunity in this bull market?
So I tell you, from the way we look at the volatility cycle will remain elevated till 2023.
Volatility cycle.
Yeah, okay. We have been saying from 2017 that 2018 till 2023, the employed walls of the most of the asset class will remain elevated. We call it volatility expansion phase, okay. Now, exactly 2023 is very difficult to predict, but because they follow 5-year compression, 5-year expansion cycle, and we have analyzed multiple vol indices globally, and then we concluded this band theory, okay. So based on that, 2023, maybe another 1.5 years of cycle is still pending. So that extraordinary choppy or volatile which is there, once this phase sail through, okay, I think India league will change, okay. So if I'm talking about somewhere financial year 2023-24 onwards or calendar year 24 onwards, things will be far superior, and obviously you will remember these such dates, when you got phenomenal buying opportunity and if you are unable to capitalize.
The macro is bad and the macro may remain bad, but is the micro getting better?
So let me, I have been talking about this 2021 till 2030 is a very unique era, okay. This is the time where everything will change, we call it global reset phase, okay. So all the growth stock which peaked out, the value is coming back, beaten down, neglected phase, they are coming back, emerging market is coming back. Maybe you just leave the temporary impact of spike in the dollar index, okay, that is also settling down, which has unnerved up to certain extent Japanese currencies or emerging market currency, but that will be again a short-term phenomenon, maybe could be a year phenomena. Once this settle down, I think emerging market will come back with the flying colors. This is something very unique about India, and I think India, the sectors we have to identify, okay, it's not about the everything you just buy the so-called all admire territory stock. This is the time you have to look at the capital goods stock, auto, or even have to look at industrials names. So you're talking about the infra names. So some sector allocation has to be right rather than just following the same sector which has been outperforming for donkey's years.
When you say volatility will remain high, what's wrong in it?
So I think it's nothing wrong in that, but only thing is that you have to make this volatility as an invisible animal, which we call it, or invisible hand is your best friend. Then you can play, because what happened, people get capitulated at the bottom of the cycle, okay? People are unable to tolerate the extraordinary choppiness which come exactly at the bottom. Look at what happened very recently. People have given up, okay? So if you are mentally prepared, this is the phase of till 2023. That's the way we brought the concept of dynamic style of money management, that in this phase, your static or buy and hold strategy, unidirectional approach will not deliver. And which is the case globally, 2018 till now, the buy and hold strategy globally has not delivered. It has underperformed, okay? So it's an opportunity that you have to look at, because we all live in a very dynamic world, okay? We talk about macros environment, but we follow same approach. That will not be very effective.
The more you're trading, the more you are putting a cost of churning. The more you're trading, the more number of hit rates you need to be getting it right.
No, it's not about the churning of the way people look at it. It's all about how dynamically you rebalance your portfolio based on the risk and risk off environment. If you can gauge the risk on and risk off environment correctly, and if you can also quantify what could be the quantum of these levels, then you can play it right, but it's not that easy, okay? So it's easy to talk about, but very difficult to practice. But at least we have been practicing for last many years, and it has worked in our favor. So we believe that this is the best way. You actually reduces your risk, okay? When you people talk about timing is bad, nobody can time the market. But if you look at the multiple data points when we combine, okay? That gives me a phenomenal edge when you talk about liquidity analytics or or the valuation analytics or risk appetites or sentiments. When all combination gives you one side data or skewed data, that's the best time to buy the market or exit the market depending on the euphoria or panic.
So when markets are bottomed out, the fear gauge or CBOE VIX has gone to levels of 60, 70, even 80. We almost went to 35 and we retreated on S&P, which clearly means that this is not like a mega capitulation, which means this is more like a bounce in a falling market, and market should retest the bottoms and make a fresh low.
So theoretically speaking, answer is yes. Okay, but if you look at again in isolation, just wall index, if you look at, then you can conclude. But if you look at the characteristic of the walls, all the walls indices globally, and then you combine with the other macro, including currency, then answer is very different. First of all, if the current crisis was so meaningful, okay, when people were giving capitulating, why people have not bought and forward the protection? Okay, VIX is very liquid instrument globally. India VIX is not tradable, but globally VIX wall indices are very liquid. S&P VIX is very liquid. You can trade option, you can trade futures, okay, but there was hardly the participation level, neither the participation level has increased, nor there was any urge to buy these things, which means the smart money still believe that this is not the big crisis, okay, as it laid out to be, because in 2020-21, between September, October, November, that was the phase when market peaked out. None of the gurus talks about, okay, and that's the way the cycle peaked out. Market was way ahead. Now, if you look at the wall indices, had not spiked up to that extent. In fact, they have not crossed even May highs also, and then corrected down, which is the endorsement that this crisis is not as meaningful as market is perceiving.
So this is like 2013 when we saw a mini sell-off. It was not like a outright selling stampede. Yes. So this is like repeat of 2013-14 when taper tantrum started.
Could be. But we have to keep in mind when we talked about that volatility can remain or the expansion phase can last till 2023, it means that we're still not over for global markets, okay? We are more vulnerable till 2023 at least, because that's the time we're talking about it can further spike. But if I have to look at the combination, that's not endorsing that, rather we just released a note last week, we talk about India fear index has spiked, okay, some of the stock specific fear index has spiked significantly. Now, even you look at the way Nasdaq corrected, I have tried to send you a picture, how the Nasdaq volatility was there. If you look at the difference, yes, it has increased. It means the hedging costs and the VXN or the Nasdaq is on a higher side, but it's nowhere close to what happened in 2000, 2001. Okay, if the crisis is something similar, what people are making out, okay, then ideally we should have gone. Yes, wall indices are slightly more elevated, but I think we have to look at from a longer term perspective. Yes, situation is bad, macro are deteriorating, okay, but if I have to look at very near term and medium term perspective, I think things are looking slightly better. So that's the advantage when the wall indices will remain elevated. You have to work on swing tradings rather than just looking at opportunity, everything from longer term perspective.
So for next 12 months, what could be the best case and the worst case scenario for the Nifty?
I think the way I look at Nifty in terms of euphoria, the way we have seen euphoria in 2008 or 6 or 4, even 2018, we have not seen any classic signs of euphoria in the Nifty or the broader market in general. That's the reason I still believe, okay, Indian market has not peaked out from a long-term perspective.
Has it bottomed out?
Has not peaked out, okay. So it means there's a potential that Indian market has potential to make a new lifetime high again, okay. Timeline could be 3 months, could be 6 months also, okay, because this is the phase when everybody has given up. Okay?
The next 12 months you expect Nifty to make a new high?
I still believe that's what data points showcase, that it is at least top is not in place. It's very difficult to pinpoint exact thing, but if top is not in place and given the Indian macros are not deteriorating up to that extent on relative basis, India is also deteriorated, but on relative basis we are in a better position. And if we can manage this next 1 year or 1.5 year cycle, which is slightly against global market, then I think India should come out with flying colors.
What could challenge your conviction?
So the only risk, if you ask me, which India has right now is the crude. Okay, commodities market has made a trading top, but crude has not. Okay, that's what our predictive analytics models are showcasing, that you will see a new lifetime high in crude, maybe very soon, but definitely in this financial year itself. Okay, it's very difficult to pinpoint exact timelines for that, but the characteristic which we look, they are showing signs of euphoria. The how technology stocks have made a euphoric move, or the growth stock has made a euphoric move in 2021. Something similar is unfolding in crude, which means that is the last risk which is pending. And by default, if crude spikes, then obviously it has a impact on the rupee also. But once it peaks out, then I think the fall will be equally sharp. Could be 40, 50, 60% fall can happen. And that could be a great opportunity. Does not mean we should not participate, because it is very difficult to time these things. Okay, but data points showcase that is the one last risk which is pending for India.
The leadership of the market has changed. They say that courses remain the same, horses they change. Autos come up, metals have gone down, IT has moved into time-based correction. What are the new leaders? If markets have to make a new high, where is the leadership?
So I think capital goods is one new leader. Infra is another, which is again interlinked thing, but definitely leadership is with capital good. Auto is another space which we like. Okay, the only problem is that sudden the noise level for auto has increased significantly, so they might also got into a smaller term, near-term correction and then start moving up. So auto, infra, engineering, telecoms, I think this is the area which is more from a domestic centric or India centric stocks should be, because capex cycle, anything which is the derivative of capex cycle, this is the area which we like to calculate, like including banking.
Auto, infra, telecom.
Auto, infra, engineering, capital goods, interlinks depending how you define it, auto also. And up to certain extent, banking should be part of it, so financials also.
So auto, infra, to a large extent banking, and also capital goods, these are commodity consumers. They will only do well when commodities are down.
So I think from a base metal point of view, I think it's a good top is in place. But if you ask me, this is a decade. We have been saying from 2019, we have talked about the 2021 till 2030 belongs to the commodity. Okay, the inflation will go up because agri prices will go to the roof. So we will see the agri prices is the biggest worry. So I will avoid anything which has linkage directly with the agri prices. Those are the areas which I am very cautious. But it's not going to be a linear move. Okay, if crude remains elevated or has still potential, then if you say that copper will not follow and copper has peaked out from longer term perspective, answer is big no. I think this the entire cycle is up, and these are significantly globally, if I have to call it, these are great value stocks. Okay, look at Indian, some of the companies are great dividend yield companies, and they are part of this sector. So I like to create a basket approach rather than just saying that I will only play this and I'll not play that. Okay?
How many stocks do you own in your portfolio?
See, some of the schemes have around 45, 60 also, but generally the large cap names or some of the middle we like to have around 30.
Are you taking concentrated bet or are you spreading yourself too thin?
So depending on the cycle, when sometimes cycle expands and you shift, that's the time your portfolio also expand. When the shifting process is over, then it also get compressed.
What is the shift you're doing in your portfolio?
So September 2021, we did a very major shift when we talked about the growth.
September 2021, almost like 10 years. 10 months, sorry.
10 months back, okay. That's the time we shifted from growth to value. It takes that much time. It takes 3 odd months to shift the entire portfolio. So that is something we shifted, and now value is our core portfolio, and trading bets or the static or tactical bets are the growth stock. That's the one drastic change which we have made, and within that we like these some of the names which we talked about, you know. So again, it's not like we are married with one particular thesis. Okay, when data point change and we see a euphoria happening, we might be booking some profits here and there, and we see a capitulative move, which is the case right now, which is unfolded in last few weeks. So it's an opportunity to deploy.
Post 2013, there came a time when small cap stocks also started doing well. Small cap stocks in general are down 25 to 35%. That's the average mean correction. 30 is the average mean correction for the small cap index. And good quality stocks which have been part of portfolios, they've seen a correction of even 50%. While Nifty has not seen a correction of 20% also. So isn't the margin of safety now more favoring small cap rather than large cap?
So let's go back for a minute on 2021. In 2020, when we talked about euphoria globally, in India we have seen only euphoria in the small caps. Okay, that too in certain pockets. Okay, so small cap, yes, we have seen a euphoria and we have seen a good capitulative move. Yes, it's an opportunity to look at, but I think the way we have to look at the quality stock, the liquidity aspect also has to be kept in mind, because this is a time when illiquidity risk is relatively high for various reasons. Okay, so you have to be careful on that. Yes, definitely time has come to increase your exposure towards small and mid also from the current level. This we have started doing.
You spoke about markets making a new high in next 12 months. Uh, what could force the market to do the other way, which is that markets keep on going lower, we go below 14,000 and we make a new low, and we go below the recent low of 14,000, 15,100, 15,200.
So theoretically speaking,
It is possible.
Okay, it's possible. I'm not ruling out. Okay, that can only happen if there is some bigger geopolitical risk. Okay, which doesn't look like right now. But yes, if I have to go by the employed walls data of the crude, then it showcases that that could be a political risk or geopolitical risk. Whenever that happens, that is the only time if it is a possible, but that only can happen for few trading sessions, because we have seen extraordinary sell-off, exhaustion, which we have seen. The risk appetite has collapsed significantly, which is the classic example, the Bitcoin. We have seen a huge selling exhaustion. So if I look at in isolation, answer is yes. But if I look at the combination of multiple data points which we run in our portfolio, the scenario doesn't look like.
IT stocks are still a good 50-60% above their pre-COVID levels. That sector has seen a correction. Do IT stocks justify that kind of an elevated P multiple? Because a lot has changed. Growth has come back, rupee has weakened, and the dynamism in the world has changed.
Yeah. See, my view is that, this is a very classic multi-decade top in terms of valuation. That's how our predictive analytic models are showcasing. We were very early in September 2021 to talk about, okay, that something has changed. I think that is a decade top. So but you have to keep in mind nothing will collapse vertically, okay, or one way, okay. So we'll know moves will be linear. So we expect even reflex rally there also. But the challenge is whether you want to participate in some of the names which I mentioned, where risk factor is low, or you want to participate in a reflex rally where risk factor is high, because these are grossly overowned. And we are trying to avoid any sector which has more global linkages. Okay, we are preferring a domestic economy in the current environment which is unfolding globally.
What will happen to stocks like ONGC, Coal India, NTPC? They've seen a deep swell. Some of them have done very well from, let's say, Diwali to Holi. That phase they've done rather well. But we are in for rain again. Do you think these are like seasonal fruits that they'll give you upticks once in 5 years, twice in 5 years, that's about it?
So no, they are also part of a value thesis which is playing out. I think they have seen they have been to most neglected territory, or the most hated zone, which we call, and they are classic dividend yield stock now. I think worst is over. They are in the structure bull run, if you were to call it. Okay, so stocks like NTPC will qualify, may not necessarily for ONGC because it has cyclical characteristic. Okay, but companies like NTPC will definitely be part, or Power Grid could be part, all the utilities company. So anything which is part of a high dividend yield and value thesis, I think that is the cycle has just begun. Whatever you have seen a small up move and small correction, I think the big picture is still pending. They're grossly underowned.
The main ingredient for any financial market is one, interest rates. Interest rates last 10 years have gone down. Next 3 to 5 years, they will go higher. Won't that change valuation for utilities? Because utilities will do well when interest rates are moving lower rather than moving higher.
So I tell you, the way we look at, okay, the developed market interests are more vulnerable, okay, because given the food inflation and now the wage inflation which will follow, at least in India, we don't see it. It is a global problem, but not up to that extent. Rather, we see by August this inflation narrative will actually come down. But we have been used to for a very higher interest rate for a longer period of time. Only in the last few years, we have seen something change, okay. I think it's a question of time that market will accept, and we are not as worried as we am worried about US market.
It's a great point that in India interest rates went down, but they did not go down in the way it went down in developed markets. And if interest rates they go higher, repo is almost 5, it will not go to 7 or 8.
Yes.
Well, in US the 10-year has gone from 0.5 bips, it may go to 3.5. It's already 3.1 now. It may just settle at 3.75, which means the magnitude of hike is going to be very large.
Yes, because US, we think the vulnerability is itself in the dollar index. I think the dollar itself is a big question mark. The relevance of Fed in the question mark, because whatever Fed has done, we have a very large thesis that inflation and interest rate will remain elevated for US market and developed market till 2027-28. Maybe right now you can see a small correction here and then, but they are in structure bull run, okay, which is not the case in India. Okay, in fact, we believe that 2023-24 rupee can peak out. and then you will see a reversal trend. India will be the leader in that post this crisis, post this wall phase, which I call it. Okay, India should re-emerge, and I don't see that big crisis for India in terms of interest rates.
So we are in this high volatility phase for 3 months, 6 months, 9 months. Only time will tell us. What will do well in this high volatility phase? I mean, typically, do you buy an FMCG because the stocks are less volatile? Do you buy banks because, do you buy private banks, they will be less volatile? What does one buy in this high volatility phase?
So the best thing is that you have to tactically shift your position based on the environment. Okay, that's the best way, because there is no answer stocks can give you. Okay, when you see a euphoria happening or complacency getting built, you have to prune down exposure, and when you see panic or issues which is there in the market right now, or capitulative move, that's the time you have to rebuild your exposure. So that's what we talk about. This is the era till 2023 where swing trades will
Entire
be
2023?
till 2023, very difficult to pinpoint. So we have
12
been
months.
saying, so another 12 months, 15 months are pending. That's it. But whether I look for India as opportunity, answer is big yes.
But if we are in a high volatile phase, high beta will see the maximum swing. And nobody can get all the trades right.
Correct.
So avoid metals, avoid banks, anything which is high beta, just avoid it.
So no, I don't think so. That because then some of the like NTPC, ONGCs, betas are significantly low. Okay,
That's why perhaps they are doing well, because we are
Yeah.
in a volatile market and these are less volatile stocks.
Correct. So that's one thesis is definitely right. But some of the which is the linked with our domestic economy, those are the sectors which is like today banking are not that expensive on relative to relative
high
to
beta.
IT. Okay, high beta definitely, but relative to what you call it, IT sector, they are less vulnerable. So I will go with those names where where under like SBI is a classic example. Great bank, great franchisee, good valuation. Look at the ownership; hardly anybody owns. So the safety is very high. So just a classic example, SBI is our, like for example's sake, is our core portfolio, and HDFC is a tactical bet. So there's a difference. And
So
that's the way we
between
like to
Jan
play.
and June, have your top 3 holdings changed?
Not really, because we have changed from September, October, we were changing. So by January, the portfolio has already changed. So nothing has changed. Like ITC is our top holding, or SBI is the second largest holding in that.
And from June 2022 to June 2023, do you see your top 3 holdings changing?
Possibly, yes.
Haven't you identified that if you're in a volatile phase, you've already made your positioning like that?
See, we are very clear as sectors we talked about. Okay, let's say auto we are talking about, and we see a euphoria happening in some of these names. We like to book profit and maybe re-enter somewhere else. So it's very difficult to pinpoint right now, but that's the way the dynamic style of money management is all about, that you have to change along with the environment.
S&P has been labeled in a bear market, 20%. The chartists would say it's a bear market. What is the label for Indian market now?
So I think I am not a guy who can talk about technical levels, but the way I look at purely from mathematical perspective, I think breaking this 15,000, 14,800, 15,200, where we have seen a plus minus 400 points, small percentage. Ideally, or worst case scenario, you should bottom out there.
Well, never say never, but in terms of probability, you think that is going to be, the probability of that is what, 1:10, 2:10, 3:10?
I will say it's relatively low to reach that level.
All right. Really appreciate your time.
Yeah.
Thank you very much. That's it on this edition of Market Makers. We've come back after a gap, but we've come back at a time when it really matters to our viewers to get the right guidance.